I'm joined today by Delphine Govender, who's co-founder and chief investment officer of Perpetua. Delphine, welcome to the channel.
Great to be here today, Chris. Thanks for having me.
100%. Delphine, so I've got a question for you. South Africa's always had a very well-regarded and effective domestic asset management industry, but there seems to be some attention shifting towards looking at overseas markets. What's driving that? What sits behind that?
It's a very interesting question, Chris. And in fact, there's probably multiple answers to this. The first point that I think is worth kind of unpacking is the current state of the industry. So you're 100% right. We do have a very well-developed, almost, excessively sophisticated domestic industry, which has developed over multiple decades now. Many of the professional houses that have been independent are probably hitting the 50-year, birthday mark, with obviously the kind of initial insurance houses way older than that. So I guess what's happening, really to just look at the market to begin with, is that the domestic savings industry is unfortunately not growing, not keeping up with the growth of how global savings industry is growing. And really, as we know, the story has really been a function of the growth of our own economy. So we don't have sufficient people that are new people being employed, an increase in contributions to institutional and retirement funds. And this has really caused pressure in terms of the amount of money that is flowing into, for example, the domestic savings industry. Coupled with that, the actual South African stock market hasn't been growing. So it's actually been shrinking in terms of the number of listings. It's really been well broadcast. And also the actual individual companies themselves are, not getting the price discovery, particularly outside the large holdings. That's also been a function of perhaps foreigners not being as invested in our market. And then a last reason has been that there's been an increase in the amount of assets that retirement funds through Regulation 28 can externalize. And so that's really caused an outflow from the South African market. So if you look at the kind of systemic reasons which have caused the fact that the South African market and the South African equity market is really not growing, what is happening is that South African domestic managers are increasingly lifting and shifting their focus to growing their global capabilities and also being the service provider to their long-standing domestic institutional clients on global offerings now.
Thanks, Delphine. That's very interesting. So there's also perception that, maybe global-based firms are better than this than say, their local counterparts. Is that a true assessment?
It's a very interesting observation, and it's a perception that's been quite long held, particularly in the South African market. And I guess I'd like to explore that a little more. And perhaps the reason is, firstly, why is that the perception? I'd say, firstly, the main reason is that naturally, South African clients have historically been used to using South African managers for their domestic assets and global managers for their global assets. It's just a function of how things have been. No different if you look at external markets where emerging market managers are used for emerging market asset classes and the like. So firstly, it's a function of history and familiarity. So it would be then that you would use the big global houses, more recently the BlackRocks, the index trackers, the Fidelity, the Bailey Giffords, the well-known brand name houses. And at the same time, South African managers, because they did, 20, 30 years ago, have their hands full covering the South African stock market, they weren't really growing their capabilities outside of domestic assets. But a lot has changed, I'd say, and I think perhaps this is what has been less well understood. Over the last 20 years, I'd say, many South African managers have been perhaps quietly, but absolutely meaningfully developing their capabilities in global assets, specifically global equities, but also other global asset classes like global fixed income. And it's interesting, Chris, because it's not just been because the South African managers have been, curious to cover global equities. It's firstly, it's a function of, how one needs to diversify one's strategies in a firm. But secondly, if you look at the South African stock market, it's actually dominated by offshore owners, by rand hedges, by dual listeds. The Richmonds, the Naspers, the British American Tobacco. So in fact, you had to learn and understand their global peers to be an effective domestic manager in the last, 10 to 20 years. And through this process, you found that South African managers have developed really solid capabilities in global markets. Now, naturally, every house will have a different strategy. Some will start with a regional strategy. Do they start with global developed markets? Others will start with a more sector-based strategy in terms of understanding the sectors that South African managers are typically good at, such as materials, financials, consumer industrials, consumer discretionary, and then expanding from that base. So that's also an approach. But as we stand here today in 2024, I think what is clear and is becoming a lot more clear, and COVID, interestingly, was an interesting test, was that investment skills has no boundaries. So the common, I'd say, misperception is that you had to be based in an offshore market to understand that market. Right. And while I'm not at all suggesting that, there isn't a huge value that you get from, the local understanding, just as we are better understanding, investors of South Africa than perhaps as somebody sitting in Brazil or Boston. Sure. The truth is that during the years of COVID, no one was traveling. And all of us got access to the same management teams, the same conferences, and this ended up being quite an equalizer. And we've started to see that, and in fact, even our own firm has managed to attract global clients who are looking for South African managers to manage their global offering, because they believe that we actually bring a unique lens to a global assessment because of our understanding of particularly unique elements of the South African market and what that could mean for companies and understanding companies in different sectors around the world.
Thank you, Delphine. So turning to Regulation 28, that's creating a whole new opportunity set for retirement funds. Can you maybe expand on that for us a little bit?
Absolutely. And it's interesting because it's exactly that is an opportunity set. And my sense is that while for many of us in the South African domestic industry, whether you were, asset allocator, investment manager, advisor to funds, etc., we all perhaps believed that the liberalization and the direction of the liberalization of exchange, control regulations on pension fund investments was likely to continue to liberalize. We didn't expect it to come as quickly as it did when it moved from 30 to 45%. So that caught most people by surprise. But it has created a range of opportunities, perhaps some unintended consequences as well. But if we look at, the benefits of it, the first thing I think to the fund itself is that it naturally increases diversification of returns. One of the critical things that I think the 30% limit did is that 30%, if you look at most finance textbooks and theory, that, the level of 30 doesn't even actually get you full diversification. You have to get beyond the 40 for you to really feel as though there's active diversification. So that's the first critical thing that it brought. And interestingly, if you look at most managers who were running, the typical balanced portfolios that were global balanced, almost all of them ran at 30% max exposure. Within that, it might have been far less to equities and more to, global fixed income or global cash. So, in fact, the 30% limit didn't really serve as an active asset allocation level. 45% does now start to serve as an actively managed asset allocation level for the average pension fund. Because I think if we look at, the large surveys, almost every manager is sitting somewhere between 30 to say 45%, not as though every manager is sitting at the maximum of 45 or even at the old, maximum of 30. So immediately this has brought, a really active call to how a fund is managed. So that's the first thing. And I think importantly, apart from the diversification, is that it increases the sources of return. So historically, perhaps there was a bias to global equity. Now, with the 45% level, really, and fortunately, it's at a time where global fixed income markets are also much more attractive. You can now get a decent exposure to global equity, a decent exposure to a diversified global fixed income portfolio of developed market fixed income instruments, some global property, where it's attractive, and then also global cash. And finally, with interest rates lifting, that global cash also starts to deliver a return. We're not just looking at the typical RAND-based, return in terms of, the RAND weakening and the dollar strengthening. So that's the first element in terms of the opportunities that are delivered to the funds themselves. The second interesting opportunity is the one that comes to the fund managers and the service providers. Historically, most houses have always had a global team And, you made the 30% decision to put the maximum offshore. It went to the global team. It was managed as a building block. And that was it. The domestic equity team didn't really speak to the global equity team. It was just, a very separate decision. As we stand here today, particularly given the extent to which many domestic houses are building their own in-house global capabilities, there's now an opportunity to really consider your overall equity allocation in an integrated way between global and domestic. And then, Chris, this starts to raise even more interesting opportunities for clients. One of the trappings of the South African market is that we don't have a lot of natural growth stocks. They tend to sit, if you think of global technology, global, biotech, global pharma, not a lot of that is represented in our market. So now you could actually say, well, what are the industries represented in the South African market? We're good on financials, we're good on some of the retailers, when the commodity cycle is in, good to have resources. So let's source those sectoral exposures from the domestic market. But to the extent that we need that global growth element, let's go to the offshore markets. Now, it's only an integrated equity team in a house, like, for example, that we do it as Perpetua does, and there are some other houses too, that is able to, really source that equity exposure holistically. This is something that was not available and I think wasn't really being pursued actively 5 or 6 years ago. So it's actually exciting to see the creative opportunities for investment management that houses that are a little bit more forward thinking in really taking the opportunity set of the increased allocation to equities that Reg 28 brings you can take advantage of.
Thanks, Delphine. I get that. So just in terms of the ability of retirement funds to, say, contribute to the broader development of SA Inc., through infrastructure developments, all of this that's now being allowed by Reg 28, what are those sort of dynamics taking place there?
Well, that's actually really interesting development. And I think what's been good about some of the changes to Reg 28, apart from, the one that we all speak about being offshore, has been this increased, understanding and requirement to increase exposure to infrastructure assets, impact investing, a greater kind of focus by the funds themselves on climate change areas, particularly in South Africa's own energy transition. So, what was quite curious was that many funds saw that the unintended, consequences of increasing the offshore allocation was that it actually reduced exposure to SA-listed stocks. And what did that mean if most of the pension funds were now externalizing, a greater level of assets? The truth, Chris, is that, as I mentioned, not all funds are sitting at the 45%. Many are below that limit, and for a variety of reasons. The second critical thing that has happened in the last few years, and this has been a combination, I think, of many factors, including, a focus on ESG, a focus on impact, is that many of the funds, the asset owners, the trustees sitting around the table, look at their members, they look at the needs of their members, and they look at where their members live, where their businesses are located, etc., and where livelihoods are gained, and are really looking, beyond just the financial return objective of the fund to the impact and sustainability element of the fund. And here I just don't mean climate change. I mean building sustainable economies, ensuring our own country has sustainable industries across the board, particularly where many are under threat. So through this, what has been quite assuring to see, and hopefully we're going to see a lot more of it, particularly with the investment in renewable energies, with the investment in infrastructure such as water, bridges, roads, etc., is that pension funds, whom I believe are uniquely well positioned because they have long duration liabilities, to then invest and match to long duration assets, such as your renewable energy plants, whether it's solar, PV, wind, etc. I would like to see that more pension funds are advised to actually increase their allocation, because historically for the last decade, it's really been the banks that have been able to extract those returns. And my sense is that these changes to Reg 28 hopefully set up, a more optimistic outlook for the way in which retirement funds can now participate through the value chain into really of those, physical infrastructure assets that are based in South Africa, particularly if some of the financial assets are now being increasingly shifted offshore.
100%. Yeah, and it's always a fluid, developing environment. So I would love to perhaps check back with you guys and maybe push on your button for future chats about this as we go forward. So I've loved having you on the show, and I really look forward to future engagements.
It's been a pleasure to be here. Thank you for the opportunity, Chris.